Good morning, traders. This is your Forex market commentary brought to you by Real ECN. Today's commentary will encompass the Aussie-US dollar currency pair. After breaking below the 200-day simple moving average and the 0.9300 level, the Aussie-US dollar market is awaiting the release of Friday's US non-farm payroll print to provide further momentum to establish clear direction. I hope that this commentary will prove to be insightful for our listeners. For instance, in line with this discussion, we're going to touch base on the Aussie-US dollar pair on the technical level. The narrative for the Aussie-US dollar market over the past few trading sessions have been tainted with volatility. The pair began this week's trading session on an ascending channel before dipping during Wednesday trading session on both the Australian and Chinese manufacturing print. However, heading into yesterday's trading session, the Fed's dovish rhetorical on keeping interest rate low for an extended period of time, coupled with the rise in US initial jobless claims count, has the Aussie-USD bullish momentum gained the upper hand over the bear. This bullish price action was not sustained before the Aussie-US dollar peaked out at 0.9310 level and fell to the 0.9260 mark on an expansion in US personal spending, which played an important role in the future of CPI reading. The market anticipates this intraday volatility to continue ahead of today's risk event, which include the Australian new home sale print and PPI number. Wrapping up this week's trading session, investors can also look forward to the US non-farm payroll and unemployment print, as well as the Chinese non-manufacturing PMI. In accordance to the SSI, which is also known as the Speculative Sentiment Index, net retail traders continue to long the Aussie-US dollar pair, thus taking a contrarian view to this crowd sentiment would suggest further Aussie weakness. Currently, there are approximately 1.5 Aussie-US dollar long position for every one short position taken up by retail traders. It is important to note that ever since the Aussie-US dollar price action dipped below the 1.9350 level, net retail traders shift their sentiment from short to into long positions. Moving forward, if this pair cannot sustain momentum above the intra-week high at 0.9350, analysts are believing that the Aussie may test an intra-week support at 0.9205 and 0.9138 further down the line. Analysis of a collection of technical indicators on the hourly time interval on the Aussie-US dollar market is suggestive of a temporary bearish market sentiment. I recommend long positions on the greenback. The Aussie began today's trading session at the beginning of Sydney trading hour, inching closer to the short-term Fibonacci resistance at 0.9279, while the Fibonacci support is set at 0.9257. Ever since yesterday's trading session bullish reversal, the trend line dipped below the 200-day simple moving average and continued to trade below the 200-day simple moving average. This trend action holds great significance as 200-day simple moving average contains more or less 1 year's worth of trading data and a forecast long-term market sentiment, and currently the pair are trading below the 200 days. Therefore, this is indicative of a long-term bearish market sentiment outlook on the cross moving forward. This view is not validated on the short-term moving average, as the Aussie-US dollar pair opened today's session above the 5, but in line with the 10 and below the 20 and 30-day simple moving average, which is collectively what the current trend holds, a sour undertone on the technical front. Moving on to the fundamental component of the Aussie-US dollar market, yesterday's release of the global commodity price year-on-year indicates that the commodity prices across the broader market has contracted 12.6% compared to last year. This was one of the factors that triggered the sell-off in the Aussie and forced the pair to break below the 200-day simple moving average, as well as the 0.9300 level. However, this slump in commodity prices has yet to adversely affect Australian trade activities. But nevertheless, the market will price in this print into future trade forecasts. Despite Australian export number rising 3.6% in the first quarter of 2014, the AIG manufacturing index show a contraction at 44.8 when previous readings sat at 47.9. In addition to that, the government will release its annual budget on May the 13th, encompassing fiscal tightening policy from raising taxes to scaling back government spending. On a broader scale, if this would have an adverse effect on the near-term Australian economic growth. Meanwhile, across the Pacific in China, Australia's largest trading partner posted its manufacturing PMI report, which expanded at a slower pace than what analysts are expecting. It grew at 50.4 when forecasts expected to read at 50.5. Wrapping up this week, China will also release its non-manufacturing PMI print forecast at 54.5. It was very clear that this week was packed full of market-moving risk events. However, most of these risk events wasn't impactful enough to give the greenback a decisive breakout and follow-through momentum. Even the Fed tapering action and the optimistic outlook on the pickup in U.S. consumer spending did very little to support the greenback. The last piece of risk event left for the remainder of this week is the U.S. non-farm payroll and unemployment rate report. However, since market volatility continued to stay at record low, most retail traders are not convinced that an upbeat U.S. non-farm payroll print will have a profound effect on the greenback. What this implies is that unless the Fed decides to change their narrative on monetary policy and interest rate, the market has already priced in the expectation that interest rate will remain low for an extended period of time. Friday's U.S. non-farm payroll print is forecast to add 210K, while unemployment rate is forecast at 6.6%, expected to drop from previous reading of 6.7%. The chances for a lower non-farm payroll print reading is ranked as very low, and the reason behind this argument include a rise in U.S. ADP private sector employment change, adding 220,000 jobs, which the University of Michigan Consumer Index also jumped from 80 to 84.10. Also reinforcing this argument is a drop in continuing jobless claim and a rise in the employment component of the ISM Manufacturing Index. I want to thank all of listeners for spending the time with us. Until then, good luck with trading the U.S. non-farm payroll, everybody.